Good afternoon and welcome to People Making Money. I'm your host, Kevin Bemmel, and we are here every Wednesday afternoon, 12:30 Pacific time, 3:30 Eastern time, and an hour in for Central and Mountain. And we talk about all things related to job hunting, professional issues, and investments and wealth building. So anything that affects your financial life is fair game for this hour that we spend together on Wednesdays. So if you saw either of my shows earlier this week, I've been touting that today we're going to talk about I put it in air quotes, magic of compound interest. So I want to talk about it in concept first, and then we're going to get down to some, I don't want to call it math because, that might send you screaming off into the netherworld, but we're going to get involved in some money so you can see how it actually works and how it can benefit you. But here's the situation. If we look at the various ways of building wealth, so let's just take some of them kind of off the top of our heads. One is you could play the lottery. Okay. Powerball. I think I read somewhere the Powerball amount is up over $1 billion, unless somebody won it just recently, $1.4 billion, I think. So I guess you could buy Powerball tickets and hope you win the lottery. And indeed, if you did, then you pretty much be set for life, at least in theory. Although, as I recall, there's a huge percentage of people who win the lottery who, within about 7 years, I believe, don't have any of the money left, if you can imagine. But that is one way of becoming wealthy. Another way is to start a business that is extremely successful and that you can either sell to a larger company for a bunch of money or maybe take public. So if you've been following the financial news at all, Birkenstock, the shoemaking company, is looking to go public soon. And they're the private equity company that currently owns them is looking to sell 39 million shares of stock at between, I think it was $44 and $49 a share. And if you were to calculate that out based on what percentage of the company that represents, and if they do in fact sell it for somewhere in that range, I guess the company would be worth about $8.5 to $9 billion, right? So if you were an early investor, or if you're invested in the private equity group that owns Birkenstock, depending on what you pay to buy your share, you're probably going to make, a whole lot of money. For most of us, probably enough money, again, to, be set for the rest of our lives. And even without something, that fabulously successful, I know of someone who started a small business, and she was eventually able to sell it for, I think it was in the neighborhood of about, $5 million. Well, if you live, reasonably prudently, $5 million can last you for, a long, you could retire on $5 million. You certainly could. Okay. So, the reality is these are some ways of making a whole bunch of money. Notice they all have something in common, and that is they entail huge risk. So one of the reasons why the Powerball jackpot, or whatever it's called, is so large is because so many people have bought tickets and haven't won. That's how it builds up. I don't know exactly what the formula is, but undoubtedly millions upon millions of people have bought Powerball tickets that didn't win, and it keeps adding to the size of the pot for the person who eventually does. And in fact, the chances that any particular ticket will win are absolutely minuscule. So, probably, well, not probably, certainly lower than, playing craps in a casino. As well, the private equity, investing in a business like that, like Birkenstock. So while some private equity firms have better records than others, when all is said and done, for people who are investing in businesses, that too is a numbers game. So if you talk to, for example, angel and seed capital investments, they'll tell you that if they're doing well, if 1 out of 10 investments does well enough to basically bring them even for the other 9 on which they lost their investment or lost most of their investment, plus a little bit of profit. So that any one business will be a home run, so to speak, is very, very small. Okay, even for experienced investors. And likewise, starting your own business. While it's entirely possible to start a small business and to be able to build it to the point where you can live, a nice life, for most of us, we're not going to turn around and sell our businesses for a large sum of money. Most small businesses just don't have an equity value like that. And especially if it's a service business, so then even less so, because with a service business, really the value in the business is us, the people who are making the business run. Now we may be able to sell our business to a similar company with us included for a while and get some money for doing that. That's always a possibility. But again, the number of people who start a business who turn around and are able to sell it for a lot of money, certainly enough money to retire on, is actually relatively small. So if these ways of making enough money to retire on, or at least have financial security, however you would define that, if these are high risk ventures, so what is a low risk venture? And probably the lowest risk venture that you can engage in, and this is just general advice, this would not necessarily apply specifically to you, okay? So I'll give that caveat here at the beginning, right? Anything that you do, you should speak to your financial advisor or get a financial advisor to look at your specific situation. But for most people, the best way to build wealth is by making periodic investments that build up over time, okay? And when they're earning a rate of return, whether it's the same rate of return year after year after year, or whether that return fluctuates, assuming you're not taking any of the money out, you are benefiting from what is called compound interest. Okay, so compound interest basically means interest paid on the interest that you've already earned. Okay, so I don't have a PowerPoint today. For those of you who don't like PowerPoint, I'm going to open up a whiteboard here. Let's see. Yeah, a new one. Okay. Let's see. Hopefully this is going to work correctly. Okay. So here we got a whiteboard in presentation mode, I guess it is. Okay. So let's just look at a real simple a real simple example. Okay, so let's say you have $100. Okay, and let's say that you put that $100 here. Well, just so you're clear, that $100 in an account that pays 4% per year. Okay, so each year. All right, so at the end of the year, zero coin. At the end of the year, okay, you're going to have earned $100 times 4%, which equals $4. Okay, so at the end of that year, you're now going to have in your account $104. Okay, and let's say you leave it in the account again for a year at 4%. Okay, per year. Okay, so this time you're going to earn not $4, but $4 and 4% of $4, which is 1% of $4 will be 40 cents. So I'm sorry, 1% of $4 is going to be 4 cents. So you're going to have $4.16. Okay, so at the end of 2 years, now you have $108.16. Okay, in other words, because you earn $4 in interest the first year and left that in the account, you earned additional interest above the $4 the second year of 16 cents. Now your total is $108.16. Okay, now you say, wow, 16 cents, big deal. Well, true enough, 16 cents may not seem like a big deal, but if you were to leave it there for a long number of years, what you're going to find is over time, the additional amount that comes from leaving the interest and letting it compound, letting it add up that way, becomes larger and larger and larger. Okay, and in fact, over a 40-year period, you're probably going to have roughly $300, I think. And so you'll have put in only $100 of your own money, and you'll have earned $200 in interest. Okay, now you say, oh, $300, big deal. Well, but you only invested $100. So if you had invested $10,000, now you would have $30,000. So you would have earned $20,000 in interest on a $10,000 investment, i.e., in other words, you would have gotten twice your investment in interest just by letting the interest compound. Okay, and keep in mind, you haven't done anything. You haven't added any money to the account. You've just put in the original amount and just let it sit there year after year after year. Okay, now, so this is the magic or the power of compound interest. Okay, now, how can you quickly figure out the power or the magic of compound interest? So I'm going to teach you a quick rule of thumb, and it's called the rule of 72. Okay, the rule of 72. So the rule of 72 says that 72 divided by the interest rate that you're receiving will give you the number of years it takes until your money doubles. So if you invest money at 1%, okay, so the rule of 72 says 72 divided by, you don't divide it by 1%, you divide it here. Let me take the 1% off. That's a little confusing. Eraser. Okay. Okay, so you don't actually divide it by 1%, but you divide it by the number of the percentage rate. So 72 divided by 1, because it's a 1% return, means it'll take 72 years to double your money. Okay, now you may be asking, well, how did you know that you'd have about $300 after 40 years? And the answer is, if you divide 72, okay, this time divided by 4, Okay, that equals 18 years. Okay, so that means every 18 years, your money is going to double. Okay, that's how I was able to work that out. All right, so this gives you a rough rule of thumb. Well, let's say you don't want to rely on a rough rule of thumb. You want to do some more precise planning. Okay, let's close the whiteboard. Okay, so I'm going to go ahead and share screen, and we're going to look at some calculations and some information. Okay, so we're going to go through an exercise of figuring out how much money you'll save if you invest a certain amount. And we're going to go through another exercise looking at how much do I have to save in order to have a certain amount after a certain number of years. Okay, so that may sound a little bit difficult to follow, but it'll become clear as we do the examples. So the first thing I want to look at is, let's look at just regular old savings account rates. Okay, they've gone up a lot in the last 2 years, as among other things, the Federal Reserve has raised interest rates. So notice I think these are the top 10 or so interest rates being offered right now. So you have 4.5%, a little over 5%, 4.5%, 4.3%, 5%, 4.3%, 5.355%, 4.755%, 5%. So you see a lot of, there's 1, 2, 3, 4. 4 out of 1, 2, 3, 4, 5, 6, 7, 8, 9. So 4 out of 9, okay, are at 5%. Okay, 4 out of 5 are at 5%. So you're gonna see in the examples, I'm gonna generally use 5%. You may think, well, that's too high, or you may know of an investment where you can regularly get 6% or 8% or even 10%. Okay, at 5%, I think is a pretty conservative interest rate, and so that's why I'm going to use that one. All right, so the first thing we're going to look at is, let's say you contribute $600 a year into a savings account. Okay, $600 a year into a savings account. All right, and you let's say you start when you're 25 and you want to know, how much am I going to have at 65, which is when I plan to retire. So that's 40 years of growth. Okay, and here's your 5% interest rate. Okay, and let's just say it's compounded monthly. Okay, so that means the interest is added to the principal balance each month. So that actually gives you a little bit more compounding than what I was showing you in the on the whiteboard was interest compounded annually. Okay, but interest can be compounded more frequently than annually. It can be done monthly, it can be done daily, it can even be done what's called continuously. Okay, and depending on the terms of the investment, that'll determine it. I'm just going to use monthly. That's kind of I don't want to say it's in the middle of annually and daily, but it's better than annually, not as good as daily. So it's kind of putting us in that sort of middle ground. Okay, so what you're going to find is, after 40 years, you have invested $24,000 of your own money. Okay, and during that time, you've gotten $50,000, over $50,000 in interest, i.e., you've gotten more than double the amount you invested in interest. Okay, so the account is worth over 3 times what you put in it. All right, does that make sense? And that's the compounding of interest. Now, notice, as I mentioned when we were working on the whiteboard, it does start out pretty slow. So here you are after, let's see, let's look at 10 years. Okay, so after 10 years, okay, oops, wait, 10 years. go back one. Here we go. So after 10 years of putting away $600 a year, the total principal, the total amount you've invested is $6,000. Your total interest is $1,588. Okay, so in that sense, you've only increased the value of your investment by about a quarter after 10 years, which, you know, doesn't sound very good. Okay, now let's go out to 20 years. Okay, so let's go out to 42. Okay, so at 2042, 20 years from now, okay, you've invested $12,000 of your own money. Your total interest is now over $8,000. In other words, while you've only set aside an additional $6,000 in that second 10-year period, the interest you've accumulated has gone from about $1,600 to, for the first 10-year period, to about $6,500 during that second 10-year period. Okay, so although in the first 10-year period, effectively your account has gone up by 25%, the value of your of the overall account based on your, starting with your principal has gone up about 25%. In this case, it's gone up by 2/3, 67%. Okay, now let's look at the 30-year point. Oops, a little too far. There we go. Okay. So at the 30-year mark, okay, so at this point, you've invested $600 a year for 30 years, or, again, $6,000 for 10 years, which is $18,000 for 30 years, okay? Your total interest is over $22,000. So although you've only put in $18,000, you've earned more interest at the 30-year point than you put in, than the money you originally invested, $18,000. Okay, so you're at about 120%, 125% thereabouts. Okay, and so then fine, it's really in this last 10 years, although you put in only another $6,000, you end up earning $50,000 worth of interest. In other words, you earned $22,000 of interest over the first 30 years. And then in the last 10 years, you earn an additional $28,000 of interest, even though you only invest an extra $6,000 of principal. Okay, that is the power of the interest compounding, because as the years go by, you're earning interest not only on the blue part, which is your principal, but on all of the interest you've earned previously. That's why this curve keeps getting steeper and steeper and steeper. Okay, now it's not going to ever go completely vertical. That's not possible, but it will keep getting steeper and steeper the longer you leave the money in. Okay, all right, now let's look at a slightly different example. Okay, let's see. Yeah. Okay, so in this case, and by the way, let me just notice you started out with no initial investment. Okay, so you had zero in the beginning, $600 a year. Now let's say instead of investing $600 a year, you set aside $50 a month, which may be easier to do because, depending on what your salary is, setting aside $50 a month, you may not notice, that money, not having that money available. Whereas having to come up with $600 at the end of the year, that may be more difficult. Okay, so you're going to contribute $50 this now monthly. Okay, still 40 years, over 40 years. Okay, at 5%. Okay, with the interest compounding monthly. Okay, so at the 10-year point. Oops, let's see. 1 second. Okay, here we go. So at the 10-year point, you've invested $6,000, but now instead of having earned $1,588 in interest, you've earned $1,764 in interest. In other words, almost an additional $200 in interest, merely by setting aside $50 monthly instead of $600 each year. Okay, that too is taking advantage of the power of compound interest. Okay, so if you make your periodic investments more frequently, even though they're smaller. Now, notice, by the way, $50 per month still adds up to $600 a year. So each year you're investing the same amount of money. It's just now you're investing it monthly instead of annually. So over the term of your investment, notice at the end of 40 years, you have you've still invested $24,000 in principal. Okay, but now your total interest is $52,301 for a total of over $76,000. Now compare that with this, where your total interest is $50,568. So by just making your investments monthly instead of annually, you end up with an additional $1,500 in interest. Okay, so 74.5 versus 76.3. Oh, actually closer to $1,800 in additional interest. Okay, merely for setting aside the money more frequently. It's the same amount over time. It's just set aside more frequently. Okay. All right. Now, what I want to do now is I want to compare this scenario here, $50 a month for 40 years at 5%, with someone who started saving later. Okay, so let's say someone started saving at 55, okay, and they only have 10 years, they're going to retire at 65, okay? So we're only going to do 10 years, okay? But instead of contributing $50 a month, they still want to contribute $24,000. So they're going to contribute $200 a month. Okay. Monthly. Here we go. Okay. All right. So they start out with zero initial investment, $200 a month, which is $2,400 a year. Okay. Which over a 10-year period, notice the total principal investment is $24,000, just like here. Total principal investment, $24,000. So both people have invested the same amount of money, $24,000. This person, $50 over a month over 40 years. This person, $200 a month over only 10 years. Notice the difference, okay? After 10 years, they've invested $24,000, but they've only earned a little over $7,000 in interest, i.e., for a total of about $31,000, less than half what this person built up. That's also a part of the magic of compound interest. The earlier you start and the longer you let it compound, the more interest you're going to earn, okay? And you can't make up for the lost interest over a shorter period of time. It doesn't work because the money doesn't have time to work for you, in the investment, okay? So the sooner you start saving money, the better, okay? And the reality is, maybe right now $50 is just more than you have, okay? And maybe you have some other priorities, right? First of all, you want to make sure you have a rainy day fund so that if there's an emergency, you don't have to borrow money to cover it, okay? And then you may have to, I don't know, set up a college fund or for your children or whatever. But as quickly as possible, you want to get to the point where you're setting money aside to build wealth, okay? Even if it's only $25 a month. So let's change this 50 to 25, okay? $25 a month means giving up basically, coffee out maybe once a week or at most, 1.5 times a week. So if you put aside $25 a month over 40 years, okay, you'll have invested $12,000, but you'll end up with $38,000. That's if you don't raise the amount ever, okay? And the reality is, as you continue in your profession or in your job, and you start making more money, so you can set aside more money, okay? So maybe you set aside $25 a month for the first 2 or 3 years, and then you jump to 50, and then after a few more years, you jump to 100, and maybe that you jump to 200, okay? Whatever it is, the more money you can set aside the earlier, the more money you're going to have in the end because of compound interest, okay? Now, while we've been talking about, what amounts to a savings account, a fixed rate account like this, okay, you don't have to invest in a fixed rate account to take advantage of compound interest. So you could invest in a money market account. You could invest in different types of mutual funds or exchange traded funds. Okay. Now, the difference with mutual funds and exchange traded funds is they won't have a constant rate of return. They will fluctuate with the market. And there could be certain years where they actually lose money if the market goes way down. But those could potentially be offset by years that are much higher than the rate of return of 5%. So, for example, I think it said in the Wall Street Journal this morning, the S&P 500 is up 13% this year, right? So if you bought an S&P 500 tracking exchange traded fund on January 1st, presumably if you bought $1,000, as of today, it's worth $1,300 because it went up by I'm sorry, not $1,300. Sorry. If you invested $1,000 in an S&P exchange traded fund, presumably now it's worth about $1,130, i.e., 13% more, $130 more. Okay, that's certainly a higher rate of return than 5% a year, which means if you invested $1,000 at the end of the year, you only have $1,050. Okay, now the S&P goes up and down, and so you have to kind of have the stomach for the greater risk of an exchange traded fund or a mutual fund. But talk to your financial advisor. That may be right for you. Look at the different kinds of investments that are available. And again, the sooner you start investing, especially investing regularly, okay, whether it's monthly, whether it's annually, whether it's every 2 weeks, okay, whether it's every week. There's lots of ways you can set these things up depending on what company you're working with, what your financial advisor has available. Okay, look at different options. Okay, just as if you invest monthly, you get more interest than if you invest annually. If you were to invest bi-weekly or bi-monthly, bi-weekly every 2 weeks, bi-monthly twice a month. So if you invested you can't do it on this calculator, but if you were to invest $25 every 2 weeks rather than $50 every month, you're actually going to earn even more interest. Okay, so $50 a month gives you $76,301. If you were to invest $25 every 2 weeks, first of all, what's going to happen is you're actually going to invest an extra $50 because there's 26 2-week periods in a year, right? Because there's 52 weeks in a year, whereas there's only 24 half months, 12 months, right? So half months bi-monthly would only be 24. Okay, so in addition to contributing an extra $50, it's going to compound more quickly. Okay, all right. So now let's look at a different issue. Let's say you want to figure out, okay, how much do I need to be earning each year at the time I retire to maintain my standard of living that I have now. Okay, so if you're just starting out, you may not have the standard of living that you want. Okay, so you may have to say, well, I'm making, $40,000 a year right now. If I were making $75,000 a year right now, I'd have the standard of living that I want. Okay, so you may have to sort of project that a little bit, or if you're a little bit farther along in your career and maybe you're already making $75,000 a year and that affords you the ability to live the way that you like. Okay, so then that's what it is, whatever that number is. Okay, so because of inflation, what it costs now to live will cost more in the future. Okay, so how do we figure that out? Well, what we have to do is project into the future what a dollar then, or what costs a dollar now, how many dollars that will cost in the future. And that's a compound interest problem as well. Okay, so I did a little research here, and this may be hard to read. But if you see here, it says during the observation period from 1960 to 2022, so last year, okay, the average inflation rate was 3.8% per year, okay? That's what it's averaged over the last roughly 60 years, okay? A little under 4%, okay? So although inflation last year was much higher than that, for several years before that it was much lower, and there were other periods when it was much higher, 8, 9, 10%. There haven't been periods when it was much lower than it was, back in like 2018, 2019. That's about as low as it goes, around 1 to 2%. Okay, so now let's look at an inflation calculator. That's what this is. Okay, so and by the way, for any of these, if you want to, and I happen to be using nerdwallet.com. It's a pretty simple one. All you need to do is search for compound interest calculator, and you'll get several that you can play with. Find one that you like. Okay. In this case, I looked for inflation rate calculator. Okay. I'm sorry, not for this. This was inflation rate data. For this, I looked at inflation calculator. Okay. And you can see I got calculator.net. I'm sure they have all kinds of them. Okay. So what we want here is a forward flat rate inflation calculator, meaning it's going to calculate into the future. Okay. So let's just take the example we were talking about a little while ago where we said, well, I want to, $75,000 a year is what it takes for me to live the lifestyle I want, right now. Okay. And the inflation rate on average was 3.8%. Okay. And I want to retire in 40 years. Okay. So how much do I need in 40 years to maintain my standard of living? We'll calculate it. And you see that $75,000 now equals roughly $333,000 in 40 years. In other words, to maintain your purchasing power, assuming an average inflation rate of 3.8%. Now, it is an assumption. We don't know if inflation over the next 40 years is going to be similar to what it was in the previous 60. You could say, I think it's going to be higher, right? So maybe you think it's going to be 4.5%. Okay, so now let's calculate 4.5%. So in that case, notice you're going to need to have $436,000 in 40 years to maintain the same purchasing power that $75,000 gives you now. On the other hand, you may say, no, 3.8% is too high. I think it's going to be 2.7% on average. Okay, well, in that case, you need to have about $218,000 in order to maintain in 40 years the same purchasing power that $75,000 gives you right now. Okay, so I'm going to go back to the example of 3.8% just because there, at least there is some statistical basis for that. Okay. So, there's $333,000 is what we need per year, okay, to retire. Okay, so what that means is, I'm going to bring up the calculator here. Okay, and let's say at the point we retire, okay, we think that we're going to be able to get a 5% return on the money that we've accumulated, and we're going to live off of that interest on the accumulated money. Okay, so what that means is, I'm sorry, let's not make it 5%. That's too low, because the amount of money you'll have is going to be larger. So let's say it's 10%. Okay, so if you're anticipating getting a 10% return on the money that you've saved over the 40-year period, okay, so that means you're going to have roughly $3,300,000 saved at the end of 40 years, okay, in order to be able to have about $330,000 a year to live off of. Okay, so $3,300,000 times 10% annually is $330,000. Okay, so the question then is, how much do you have to be saving each period in order to have $3.3 million in 40 years? Okay, so our investment goal is $3,300,000. Okay, and you're gonna accumulate your investment over 40 years. Okay, you're gonna have a zero initial investment. Let's assume a 5% rate of return right now, and let's say you're gonna make monthly contributions, and this, by sliding this, your periodic contribution, and watching this, your plan falls short of your goal, we're going to find out how much you have to save each month in order to have the $3.3 million. Okay, so let's take it up to $200 a month. Here we go. Okay, so at $200 a month, it says your plan falls short of your goal. Okay, and indeed, at $200 a month, you've only produced about $300,000. Okay, so let's double that to 400. Okay, so at 400,000, it just doubles what you have, $600,000. Okay, so let's go to $1,000 a month. 90,000. Okay, so after $1,000, if you're investing $1,000 a month, you've accumulated $1.5 million after 40 years at 5%. Okay, now you may say, wow, $1,000 a month in savings, that's a lot. Yes, it is. Okay, but it depends on your salary. All right, so the reality is it's going to take about, went too far. It's going to take about $2,000 a month, actually a little bit more than 2,000. Let's try 2050. Okay, so it's going to take $2,200 a month to save up $3,300,000 in 40 years. Okay, or roughly about $25,000 a year. But keep in mind, wait. Okay, yeah. Okay, so here's the thing. One of the assumptions we've made is that you're not going to use any of your principal once you retire. Okay, but that probably isn't the case. You're probably going to start using some of your principal. Okay, so the reality is, in order to maintain your lifestyle, you may not need quite that much. Okay, and this is why, by the way, you want to talk to a financial advisor, because they're gonna help you figure this out specifically to your needs. Okay, so you can see that setting aside a couple of $1,000s a month that's a lot. Okay. 25 to 50, 10 years. Yeah. Okay. But the reality is that you've set aside 250, you've set aside $1 million total. If you're setting it up roughly $1 million total, if you're setting aside $2,200 a month over 40 years, and you end up with over $3 million. That's the power of compound interest. That is the magic of compound interest. Okay. Now, again, we've been looking at examples where there's a fixed interest rate. By the way, let's look at this. Let's say you didn't get 5%. Let's say you got 6%. Okay. So if you're getting, oh, it went back down to 5.5. Okay. So if you're getting 6%, okay, now you only have to, now you only have to set aside $1,700 a month in order to reach your goal of $3,300,000 at the end of 40 years. Okay. And let's just take it up to, well, here, let's do a search. Average return SP 500. Let's just see what we get for that. Okay, so the 30-year average return on the S&P 500 was 7.5%. Same with the 20-year return, the 5-year return, the 10-year return was higher. So let's use now. Let's use 7.5%. Okay, so if we take it up to 7, let's say you put it in an exchange traded fund, and that tracks the S&P 500, and you did that over 40 years. Okay, how much would you have to set aside? Oops, went too far. There it is. Okay, you have to set aside, $1,100 a month. So if you set aside $1,100 a month in an S&P exchange traded fund, again, past performance is not necessarily predictive of future performance, but if you had done that 40 years ago, okay, and you got an average return of about 7.5% a year, so you would have over $3 million now. And by the way, look at the difference of what you invested. So your total investment, wait a minute, that's not right. So your total investment is 1,100 times 12. It's about 13,000 a year times 10, 130. So you've invested about $500,000, and you end up with over $3 million. That is the power, the magic of compound interest. Okay, so I know that was a lot of money, i.e. math. Okay, but don't freak out. It's not half as complicated as it looks, especially since nowadays you can go online and find these calculators and just plug in numbers and have a sense of how how things end up. Back when I started doing this, there was no internet. You had these books with what were called constants in them, and they were numbers you use as multipliers. And you would, like, if you had $100 and you wanted to know, how much would I have after 10 years at 5% compounded annually, it would give you the factor for that, and you multiply 100 times that factor, and that's how much you would have. It was much more difficult than having online calculators. So now with online calculators, you can you can do it a lot more easily. Okay, so what is sort of the moral of the story? In order to take advantage of the magic of compound interest, there are two keys. One, start early as possible investing money, even if it's only a little bit. Get in the habit of investing money. And two, keep investing periodically, keep adding to it, because just as the interest builds up, if you're building principal at the same time, that's how you get that steep curve, especially towards the end. Okay. And the curve keeps getting steeper and steeper over time. So the earlier you can start, the better off you are. Well, we're actually a little bit early today, but that's all right. No sense in belaboring a point. So I thank you very much for joining me. I hope you found this enlightening, if not interesting. Hopefully money is interesting. I know, cliched, but we won't say it out loud. In any event, that this is our last show for this week. Monday at 10 a.m. with Trusts and Estates Weekly. Monday at 10 a.m. Pacific time, Trusts and Estates Weekly. Tuesday at 11 a.m. Pacific time with Business Lessons from the Military. And 7 days from today at 12:30 p.m. Pacific time, we'll be back again for the next episode of People Making Money. So just a couple things before I let you go. If you're not a subscriber to our YouTube channel, please do consider subscribing. That way you'll always be notified when a new episode posts. And also, if you have an interesting way of making a living, and you think you would make a good guest for the show, or you know someone like that, do send me an email, thewaytowowshow@bemel.com. The email address will be in the show notes, and let me know about you or the person you have in mind. Maybe you will appear on a future episode of the Way to Wow Show. And likewise, if you are involved professionally in trusts and estates and probate matters, would also love to consider you as a guest for Trusts and Estates Weekly. So let me know about that. It's always fun to have guests, and that way, you don't have to listen to me. You can listen to somebody else. So that's all for today. Thank you very much. Wishing you a wonderful rest of the afternoon, and signing off. Marie, you are my bell. All the best, folks.